The American dream is now as elusive as ever as homeownership becomes more and more unaffordable. Well, why is this? Let's discuss this with Eric Basmajian, founder of EPB Macro Research. Eric is calling for a major housing correction up ahead. Exactly how severe we'll be discussing today. Prior to EPB Macro Research, Eric was an analyst at Panorama Partners. Pleasure to have you on
Hey,
Kitco.
David. Thanks for having me on.
Excited to get your take on housing. Housing is something that affects everybody, whether or not you're an owner or a renter. Let's take a look at some valuation metrics that have traditionally been used to gauge whether or not the housing market is undervalued or overvalued. The first is the home price to median household income ratio in the U.S. It's currently at 8. So we are at a level unprecedented since the early 40s, Eric. What does this mean for the home price index going forward? Do you think this is just a new norm, or do you think we're set up for a major colossal correction?
Yeah, thanks, David. So the valuation metrics in the housing market are quite stretched, as you noted, but they're quite stretched across any asset that you look at. If you look at various measures of the stock market, they're quite elevated as well. And in my view, this is a symptom of basically two different issues or two related issues. One is that since 2000, in one of the charts that you noted, we've had persistently declining interest rates. Interest rates have declined from about 6% down to about 2%. Now they're hovering at about 3%. And this persistent decline in interest rates acts like gravity. So lower interest rates, all else equal, fuels higher valuations for all assets. We see that in the stock market, and we see that in the housing market as well because of the impact on mortgage rates. The second issue is really aggressive monetary policy from the Federal Reserve in the form of quantitative easing. And what this has done is this has provided a lot of liquidity to financial markets, and that's caused an increase in asset market inflation, such as stocks and housing, but it hasn't leaked into the CPI, not until the COVID era, in which we did very aggressive fiscal stimulus. So the two things that are contributing to a really large push in housing valuations and asset valuations were the persistent decline in interest rates and the aggressive monetary policy, both of which are coming to an end now.
That's right.
So that would suggest that home prices would start to turn lower. I actually have a variety of leading indicators of home prices, many of which have turned to the downside already.
Can you share with us some of these leading indicators, Eric?
Sure. So one thing that's really important to remember with the housing market is you have to separate volumes and prices. Everyone obviously cares about prices because that's what we pay, but the housing market is really a volume cycle. And volumes in the housing market actually peaked in August of 2020. New home sales, for example, are down 51% from August of 2020, and volume leads price. So whenever you see a huge decline in volume, something to the tune of 50%, that's generally foreshadowing declining prices to come. Other things that would be a leading indicator of home prices would be things like the month's supply of new homes. We've seen the month's supply surge to 10.9 in July, which is the highest reading that we've ever seen since the '08 crisis. A balanced market's about 5. We're at about 11 now. The one more leading indicator that I want to point out is the spread between mortgage rates and treasury rates. Of course, treasury rates are really what drive mortgage rates, but there's the treasury rate and then there's the spread on top of it. And as that spread widens, which it is now, that indicates that mortgage lenders are seeing a lot of risk in the market. And we see that spread between mortgages and treasuries at historic highs, levels that they're generally not at unless the economy is in a recession. So we have declining volumes, increasing months supply of new homes, and we have widening mortgage spreads. All of those things, to me, would suggest that home prices are going to start to fall.
Well, the 30-year mortgage rate, as you've pointed out, is at a multi-year high. In fact, the highest has been in more than 12 years. But I'm just curious as to why you're looking at the spread and not the absolute level of the mortgage rate.
Yeah, so I definitely look at the absolute level of the mortgage rate, and I look at the rate of change, which has been one of the fastest changes we've ever seen. But the reason that I look at the spread is because the mortgage rate can decline if the treasury rate declines. So, for example, if the Fed decides to get up there and lower interest rates, that would push downward pressure on treasury rates, and that would put downward pressure on on mortgage rates. But if the economy is in a deep recession, let's say like in the middle of 2008, you can have declining treasury rates, but rising mortgage rates because that's the spread. It's almost like credit spreads.
Okay.
In the corporate bond market, you can have corporate rates declining because the treasury rate's going down or the spread is compressing. So it just gives you a little bit more granular look as to what's driving the change in the mortgage rate. Is it being driven by the treasury or is it being driven by the spread?
Well, widening credit spread, like you just mentioned, also signals declining confidence in the health of the corporate sector. Do you think the same logic could be applied here? If you have a widening mortgage to treasury spread, it signals declining confidence in the housing sector?
Exactly right. So mortgage lenders would be looking at the environment saying, there's record high gas prices, record high food prices, real incomes are declining. They generally see risk on the horizon. Federal Reserve is tightening monetary policy. Recession risks are building.
Yes.
So they're going to want to build in a buffer of lending above the risk-free rate. So I believe it's exactly the same concept. So I absolutely look at the mortgage rate as an absolute number, but looking at it in terms of the spread as well gives you a secondary look as what's driving the change.
Before I get your prediction on the housing market, I do want to talk about the correction you just mentioned. I want to talk about some of the things that had happened in 2008 and whether or not those things can happen again. So we had mass foreclosures all across the board, people defaulting on their mortgages, obviously a Lehman collapse, as you know, where the entire system basically had a domino effect and everything fell apart. How much of that can we see again this time, given that banks are, some would say, a little bit more better capitalized? We don't have a huge systemic risk of MBSs collapsing like we did in 2008, but how bad could it get?
Yeah, so when we look at the housing market itself, there are some troubling signs in terms of the rate of change in mortgage rates. As we just mentioned, the affordability problem is just as bad, if not worse, than it was in 2008. When we look at the new home market, the month supply is rising to almost the same level that it was in the depths of the crisis. So when we look at the housing market itself, the affordability, there are issues in the housing market that look quite similar. However, the broad macro landscape is not the same. And what I say in response to this is that if we're looking at the housing market in isolation, there are some worrying signs that could portend downside in a similar fashion. But there's significantly less risk of a housing downturn morphing into a banking crisis, which is what happened in 2008. And the reason for that is because in the lead up to 2008, the debt buildup, or sort of the debt bubble, was very concentrated in the banking sector and the household sector in the form of mortgages. If you took the banking sector debt and household sector debt, it was about 220% of GDP. Today, financial sector and household sector debt is only about 150% of GDP, so 70 points lower. So there's much, much less of a debt buildup in the banking sector and the household sector, which would indicate that there's a significantly less chance of a banking crisis or the downturn in the housing market morphing into something much larger. However, there are a lot of signs that the housing market is going to go through a downturn, and perhaps a severe downturn. And it's extremely important because the housing market is one of the best leading indicators of the broader economy. It's very, very, very difficult for the broader economy to withstand a sharp downturn in the housing market. There's a lot of economic activity that's attached to it. So my current belief is that we are going to go through a housing downturn. I believe it's already started, and that's going to ripple through the rest of the economy. But I don't believe that the same systemic risks are there for something like 2008.
Okay, I do want to get your prediction on how bad this correction could be. I'm just going to leave the audience hanging a little bit, Eric. I am doing this on purpose, so if you're watching this right now in the comments, right down below what you think is going to happen in the housing markets. Eric, I want to draw your attention to the consumer debt service payments as a percentage of disposable income ratio. And the reason I'm bringing this up, Eric, is I want to ask you whether or not consumers now, or people with mortgages now, can afford higher mortgage payments going forward, and whether or not we're going to get mass defaults or foreclosures like we did in 2008. Now, this ratio consumer debt service payments as a percentage of disposable income, it's actually much lower than in 2008. Now, I am looking at Q1 data, so it's 1 quarter behind. And as you know, interest rates have been ticking up, so I expect this ratio to get a little bit higher. But even then, we're currently at about 5.7%, 5.6%. And back in 2008, it was at 6. Question for you, Eric. Do you think people will be able to afford higher mortgages now?
Yeah, so there's a couple of things that I want to address there. One is that the chart that you just mentioned is interest expense as a percentage of disposable income. I prefer to look at all of these measures as debt as a percentage of GDP or debt as a percentage of total income. There's not a lot of great academic research supporting debt service ratios. And the reason is because if you go into a recession, your income will fall quite rapidly and interest rates tend to rise. So it tends to be an indicator that can change very quickly. So for example, the Federal Reserve is raising interest rates now. And if the economy goes into a recession, we'll have a double whammy of rising rates, lower income. That'll make that recession, that indicator spike quite rapidly. In other words, it doesn't give you a great forewarning of what's to happen because of how quickly that ratio can change. When we look at debt as a percentage of income, we see how many times people's income have they borrowed, which will ultimately have to pay back. Another point is that the real income crisis is significantly worse today than it was in the lead up to 2008 because of the high levels of inflation. We won't have a situation where it's going to be very difficult for the consumer to absorb higher home prices, in addition to higher mortgage rates, in addition to higher consumer prices across the basket of goods that they're normally consuming. So I don't think that higher mortgage payments are something that the consumer is going to be able to absorb here, not until the Fed gets inflation down. But the catch-22 there is they're not going to be able to get inflation down without inflicting some pain on the economy, which will raise the unemployment rate. So we're in a really difficult position here. And I think that asset prices, not just home prices, are going to have to adjust in response to the situation that we're dealing with.
All right, so let's take a look at the valuations of homes going forward. So I'm looking at the Case-Shiller U.S. National Home Price Index, which is a basket of homes across the country. And this is still at an all-time high. It hasn't fallen down yet. I mean, we're seeing some indicators of slowdowns. For example, in certain jurisdictions, certain large cities, prices are going down. Home sales, overall sales are down 20% from a year ago. But generally speaking, the price level on an aggregate national basis is still high. How far do you think we can correct? In other words, you're anticipating a correction by how much? 20%, 30%, 50? Do you have a target in mind?
Yes. So with the Case-Shiller index, it's quite a lagged metric. So I believe that the last Case-Shiller report was as of June, and we're in August now. And the June data actually takes an average of the last 3 months. So we have June, May, and April. So we have a quite a lagged metric there, which is why it's still lingering towards the highs. I think when we look at some of the more real-time data, we're starting to see some very, very marginal declines in some areas of the country, certainly a flattening out in almost all areas. I'm much more concerned about the new home market, the new construction market. We actually have a really interesting divergence. The month supply in the new home market is up at 11, which is extremely high, '08 levels. But the month supply in the existing home market is still down at 3, which is extremely tight. And that's because that most people refinance their mortgages at 2.5%, and now they're up almost at 6. So no one's going to sell their existing home to buy a new one and lose that mortgage rate. So I think that the downturn in prices is going to start in the new home market. I think it already has. And I think we could be looking at corrections there in the 10 to 15% range that will spill over to the existing home market, but I think some to a lesser extent. So for new homes, I'm thinking that the price corrections, at least with the current data that I'm seeing now, could be in the ballpark of 10%. We'll have to adjust as we get more data going forward. But the month supply number is quite alarming in the new home market, and therefore I think that price declines will start in the new home market and the most speculative markets around the country.
I see. And which type of housing markets do you think will be affected most? Is it condos? Is it townhouses? Single unit family homes? What do you think?
Yeah, it's tough to say because it's depends on where consumer preferences fall. was a massive overbuilding of apartments over the last 10 years. A huge source of economic growth over the last 10 years was from the construction of new apartments and high-end apartments at that. So when a lot of people talk about the supply of the housing market, they generally localize that argument to the single family home market. And on that basis, we have some tight supply. But if we look at total units, which would include all the apartments and all the units inside of an apartment, we actually have quite a lot of supply relative to the population, supply levels that are actually at like 2006, 2007 levels. So most of the overbuilding was in apartments, but that doesn't necessarily mean that these apartment buildings are in bad shape, because consumers may have a preference to rent versus to buy if they can't afford it. So it's difficult to see where it all shakes out, but I just want to caveat that supply narrative that we have to look beyond the single family home market, because not everyone lives in a single family home. You have a easy substitute in the form of renting. And when we take into consideration total housing units, the supply story changes quite a bit.
That's very interesting. I want to talk about the effects on or the effects of immigration and foreign direct investment now, Eric. I grew up in Vancouver, so I live in Canada right now, and a big source of the increase in home prices over the last 20 years in Vancouver was due to investments from Asians and Asian immigrants. Now, immigrant money, for the most part, was not really impacted by mortgage rates. In particular, if you look at the way they've been buying, which is mostly with cash. And so, Eric, my question is, yes, we are entering a slowdown. Mortgage rates are rising, but do you think that foreign direct investment from either Asia or the Middle East or Europe can still play a factor in propping up prices, or not much?
Yeah, it could. We have in the U.S., we have large trade deficits. The inverse would be capital inflows back into the United States. That's certainly the possibility. I also think that there's a possibility that there's a lot of perhaps wealthy foreigners that are looking to get their money out of their respective countries, given that their currencies at large are declining quite rapidly against the U.S. dollar. So in my view, the U.S. dollar is going to continue this upward trajectory, and countries around the world are going to suffer declining currencies. So I do believe that U.S. assets are still going to be the safe haven for most people around the world, whether that's U.S. Treasury securities or U.S. assets more broadly.
Well, inflation is a big theme right now for everybody, investors and regular folks alike. Let's take a look at this chart. This is the CPI index versus the Case-Shiller home price index. I rebased both series to exactly 20 years ago, so the start of 2002. And as you can see, yes, while the housing market has had its dips, notably in 2008, 2009, it's recovered and has significantly outpaced the growth of inflation over the last 20 years, with the CPI rising about 66% and the housing pricing, the home price index rising about 151%. So my question is, Eric, do you think housing will continue to be an outperformer relative to inflation? And is housing the ultimate store of wealth for anybody?
Mm-hmm. Yeah, so I think that this spread that you're noting here on the chart will start to converge. I can't necessarily say that the housing line will fall under the CPI, because that largely depends on the Federal Reserve's reaction function. Most of the reason for the housing outperformance over inflation, in my view, is because of the persistent decline in interest rates and the heavy support in monetary policy. When we look at monetary policy, there's a metric called the velocity of money. Take GDP and M2, the difference is what we call the velocity of money.
Yes.
And the velocity of money has been on this persistent downward trajectory. And what that generally tells us is that the increased money supply in the economy is not going towards producing new goods and services. It's mostly being channeled into financial assets. So to the extent that the Federal Reserve limits their support of the economy and limits their support of financial assets, like what they're doing now, if they were to maintain this stance for, let's say, a year or 2 years, then I believe that housing would significantly underperform. But if the Federal Reserve is forced to change their policy quickly, let's say in the next 3 or 4 months, then that will prevent housing from having a meaningful correction. So if we take the Federal Reserve's word for it, They're going to stay committed to this path of tackling inflation. And that looks like it could mean another 6 to 9 months, maybe even 12 months of restrictive monetary policy. And if that's the case, then housing is likely to suffer for the foreseeable future because the outperformance was really due to the excesses of monetary policy. So, if we're going to reverse all of that, then it would make logical sense that housing would have the opposite effect.
Interesting, Eric. Finally, I want to touch on demographics, starting with the younger side of the population, and then we'll talk about the aging side of the population. So, yes, millennials, Gen Zs, studies have shown that they actually do want to own homes. So I'm just reading the CNBC article from June. It says specifically among millennials, 65% of those polled identify home ownership as a top sign of success. Now, it also says later on in the article that, according to an analyst they talked to, non-home owners cite insufficient income, high home prices, and not being able to afford a down payment or closing costs as the main or the most common barriers to becoming a homeowner. So basically, young people want to own a home, they just can't afford it. What does this mean for the housing market in the next 20 years?
Yeah, it's a big problem, not just for the housing market, but for the demographic situation in the country more broadly. The younger population, the 25 to 54-year-old cohort, is really the engine of economic growth because they consume the housing and they consume durable goods. That's the engine of the economy. And if the 25 to 54-year-old cohort is suffering because of low income and high debt, we have to remember that there's a big student loan problem, and all of that debt is really held in this 25 to 54-year-old cohort. So if this generation, the 25 to 54-year-olds, are saddled with debt, they have low income relative to inflation, and they can't afford to advance, that's going to put massive downward pressure on the economy because we need the younger generation to continue moving up. Secondly, and this is more of a long run variable, is it delays household formation. If you're in your 20s or you're in your 30s and you haven't bought a house, it's causing people to get married later. It's causing people to have children later. That's reducing the aggregate number of children that they have. And all around the world, we see this phenomenon of really a baby bust. And that's really a function of delayed household formation and pushing asset prices out of reach of the younger generation. So I think that the decline in demographics that we're experiencing is directly related to this crisis of affordability of housing. And to the extent that it continues, that's going to make the demographic situation worse, not just here in the United States, but everywhere else, which is actually having a worse demographic crisis than we are here.
I'm just speculating here, but maybe on a longer term horizon, maybe the current generation and perhaps the millennials and Gen Zs might find it difficult to buy a home. But all these factors that you're listing now, declining household formation, the unaffordability of housing prices, all that points to me, Eric, to a decline in the household price long term, or a secular cyclical decline of the housing price long term, which may suggest to me that the next generation after Gen Zs might find it more affordable to buy a home. Perhaps.
And it's likely the solution to a problem that we have, although it would be a painful solution. Declining asset prices is never a good thing, but if we continue to support asset prices at a level that way exceeds the real economy, then we create a problem of its own, which we're obviously going through now, which is that the younger population simply can't advance. They stay living with parents for much longer. Obviously, it's difficult to start a family if you're living with your parents, and that starts to undermine the demographics even further. So I think it's a problem either direction that you choose, and declining home prices, in my view, would correct the problem faster.
Eric, I see all these social media posts, discussions, whatever you want to call them, online, Instagram, Twitter, whatever have you, about the debate, home ownership versus renting. People have said that perhaps renting is a better long-term financial solution. Yes, you don't have equity, but you don't have to worry about extraneous costs associated with owning a home, either a condo or a single-family unit. What do you think? Home ownership versus renting?
Yeah,
for younger people.
It's the age-old question, right? I tend to fall in the camp that if it fits within your budget, then owning a home is great.
Okay.
I think a lot of people underestimate the costs of home ownership because
Yeah.
obviously you don't just have your mortgage, your principal, and your taxes, but there's insurance, and then there's maintenance that goes along with it, and you have to factor those costs in as well. If you're able to fit those costs in, then I think that home ownership is a great thing. I also think that there's a trap with renting in that you can usually rent above your means. It's easier to rent a house, let's say, that you can't afford if you were to buy it. So I think what it really boils down to is living within inside your means, and if you can do that either renting or buying, and you save and invest the difference, then I think either outcome really is beneficial. So I think it tends to be personal preference.
What if you already own a home? Should you buy a second or perhaps third home if you can afford it, purely as an investment? Maybe you like to rent out your second home.
Yeah, I think that renting real estate is a good investment. Again, I generally tend to fall in the camp that it shouldn't be done with excess leverage. It shouldn't be done with debt. I wouldn't borrow to buy rental properties in the same way that I wouldn't borrow to invest more in the stock market. I think leverage generally tends to work out poorly, because if you buy a bad investment and it's not leveraged, usually you can get out with your head still intact. But if you make a bad investment with a lot of leverage, it could end up being problematic. And we're at a point in the market now where investing is great and accumulating for the long term is great. But if you make highly leveraged investments and the economy slips the wrong way, that could potentially be devastating. So I think it could be a good investment, but I wouldn't do it on a leverage basis.
So here's an argument, well, not really against, but I have a friend, this is a real story. I have a friend, a close friend of mine who lives in Vancouver, again, a bubbly real estate market, as you know, and he was debating buying a condo as an investment. And he was saying to me, well, the math doesn't really work out to me, David, because the home price is already so high. In order for me to cover the cost of the mortgage, I would basically need to bring down the monthly mortgage payment so that it almost equals rent. And to do that, he needs to basically put down a $500,000 down payment, which he has, but it's like a big chunk of change. And he says, well, with the prices already this high, with capital appreciation, a low probability, I may as well just deploy that $500K to something else that's going to grow. The rental yield basically on that thing is going to be nothing because his mortgage cost is going to be basically equal to his rental income. So he's like, it's not really worth it for me.
Yeah, I would tend to agree with the logic of your friend there in a situation like that. I think that in a lot of these areas, home prices have been pushed to such an extreme level that you really can't make any money renting it. And at the end of the day, that's sort of where the home should derive its value from, of what you can rent it out for. I think, with home ownership, we have to separate, a home versus an investment. If it's a home for your family and it fits within your budget, I think it's a great thing. But if we're talking about buying homes for investments, then we have to be very careful of things like that, like the rental yield, which in some of these cities has gotten to such extreme levels that it just really doesn't make any sense.
Yeah. All right. Great analysis, Eric. Where can people find out more about your work?
Yeah, so I put a lot of videos on YouTube. If you search EPB Macro Research on YouTube, there's a lot of free content there. Otherwise, you can find me on Twitter at EPB Research and on my website, epbmacroresearch.com.
All right, we'll put those links in the description down below. Eric, thank you for coming on Kitco, your first time, hopefully not your last. And thank you for watching Kitco News. I'm David Lin. Stay tuned for more.